So I do expect one more rejection of silver at the gateway of 45, 50 range. So I'm curious
Yeah.
what the others think, and let me hand back.
Yeah, I mean, I personally think silver is going to blow right through 50. So, we can agree to disagree.
So what I suppose I'm trying to say is that investors should be have a steady hand and have to be prepared that there might be a downturn, and downturn might be severe and it might be prolonged.
The precious metals markets are approaching a decisive moment, with gold and silver both pressing into critical technical zones. Gold has continued to grind higher, and its momentum suggests further upside remains likely. Yet, silver stands at the center of attention, nearing the historically significant $45 to $50 range. This level has acted as a formidable barrier multiple times in the past, raising the possibility of another rejection before any sustained breakout occurs. Such a setup underscores the tension between short-term trading dynamics and the much larger long-term structural forces now driving the metals markets. FrancisHunt, known as the market sniper, brings a disciplined technical approach, blending macro analysis with tactical positioning to identify key breakout structures. MarioInnecco, often called Innecco 64, offers a perspective grounded in sound money principles and the role of gold and silver as protection against systemic risk. Clive Thompson contributes his insights as a market analyst focused on historical parallels and investor behavior during turning points. Together, their views provide a balanced framework, acknowledging silver's potential rejection at $50, recognizing the possibility of a sharp breakout beyond, and reminding investors to stay steady even if corrections occur. This convergence of technical setups and macroeconomic drivers suggests a period where patience, preparation, and long-term conviction will be rewarded. Precious metals may still deliver sharp moves in both directions, but the underlying trajectory remains one of strength. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Other people that are not so familiar with the charts when you're first entering, just to remind them, where we are. This technical structure here is a very formidable one.
Yeah.
Here. And the expectation is measured moves, to the upside, for which, we still got a long way to go on top of a trend like that. We've got a medium short-term target, which is just for that, because we also leverage trading inside of this. So we like to position in macro bull trends, be owners and investors in those trends, and then double up and max up on unique opportunities of continuation inside of that trend with conservative tight stop entries. And the one we took recently, so let's get out of the monthly and go back down to the time frames for the more here and now, is this particular pattern, which was brought about when, having made our 29,3,000 target, 3,000's, whoops, roughly there, sorry, let's take the second line, get it right, roughly there. Having made that target and had a pullback, we then had the extra blow-off moment. It's not a final blow-off, by the way. I'm just saying a little bit of hyper acceleration brought about by Trump's tariff tantrums, which, can I remind everybody, especially those that are waiting on a dollar super surge in the milkshake theory, that in fact rates shot up and the dollar crashed and gold climbed, as you can see here. But that was a little bit too much too quick, and we had a bit of a correction after the fact that this all came from the 2000 level, where we'd had another similar setup like that, which I've shown many times. I can go back and show you, but I think let's just stay with where we are for now. So this is the classic for us, continuation. So we were early once on this move up. We thought that might be the breakout. Once it failed to clear that high and turned around violently, we sold, and I ate a little bit of red there, and we came back, and then we were buying again here. And that's been incredibly profitable, and most of the proceeds will be turned into fresh investment. There is a little bit, so if I talk more about the shorter term, so that's kind of the daily, I'll just expand this area a little bit more. and maybe drop a time frame for the technical assessment, and you can tell me when you've had enough. That looks like a very small time frame shooting star, hence why we've gone into another small consolidation. But as we always bias on big macro bulls, we like the continuations generally to break to the upside. So the Sunday open, which is something that might transpire shortly after we finish here, is going to be an interesting one for us, because this target, I didn't make this clear, sorry, this target over here, we still expect a 3,768 to be run. So we're still up here before you might have a rest. And we're about 75% of the way, or 65, I don't know, call it 70% of the way we were in from here. So we've got another 30% on our leverage long. So we are leveraged long quite heavily, but with very tight risk. And we should be closing the leverage at the 37681. I made one other point, and sorry, I've spoken for a bit and I want to hand back, but just an additional point that might be additionally interesting for the viewers and for both of you is that if gold is to make that percentage further move, which is roughly another $120, you could find silver have a little bit of an outperformance surge, because we expect a 45, a mid 40s to 50 rejection, a third rejection. So this extra 120, if it occurs as we anticipate on balance of probabilities, there's no guarantees in anything, we'd be closing our leverage on our gold, but we have a little bit of on silver too. And I wonder if silver will have that move that will take it into that very sensitive area that is approaching 50. So it might just be worth forestalling your technical question on silver and showing everybody on a bigger time frame how close we are to that. And in fact, if we go monthly, I think this is the highest monthly open candle we've ever had. No, not quite. Quarterly it will be. I'll just go 3 monthly to get the 90s, 80s properly in there. At the moment, at a quarterly level, you've never been this high. So if we finish the quarter, we are in September, so the end of September is a finish point. We could be closing at an all-time high for silver quarter. If this surges a little bit more into this space, this is the third rejection we are waiting for. So there might be some market disinflationary forces that are not very far away, which brings us back to your question that you gave as the message for this particular chat that we're having around sovereign debt crisis. So I wonder if gold getting another 120 gets silver into this zone, whereby it has another little handle dip back before breaking. And that to me will be the final time you'll be in known price zone area. So we think a third time. We find this technically very significant. Once, twice, 3 times. What happens that gives it a little dip back? And then this is when I will remain leveraged long with very large targets. And I would expect to hold those positions for a very long time. So I do expect one more rejection of silver at the gateway of 50, 45, 50 range. So I'm curious what the others think, and let me hand back.
Yeah, I mean, I personally think silver is going to blow right through 50. So, we can agree to disagree. As for gold, I've got a target because I'm looking at this triangle, symmetrical triangle that you did as well on weekly basis. And I've got this formation from 2,600 to 3,500. That's $900. So I expect after the break here, which was, let's see, around
3 fours.
Yeah, with 3-4, I expect 4,300 because you do 3,400 plus 900. So I personally think and I'm talking more long term and people holding and stacking. I know you're talking more about trading paper gold, but I'm sure you also hold physical gold. But maybe if there is a sovereign debt crisis, yes, it's deflationary, but people are they're going to go for the safety of gold, I think. I'll let Clive give his opinion on that now.
When I look at the gold price and how it's behaving and what it's doing, it does look like it's almost unstoppable. But I have to say, we mustn't rely on that. I mean, many times we see in history, we've seen things which look like they're unstoppable, and suddenly they turn around on a sixpence and do the opposite of what you expect. So what I suppose I'm trying to say is that investors should have a steady hand and have to be prepared that there might be a downturn, and that downturn might be severe and it might be prolonged. Now, I'm not predicting it, and I don't even think it's going to happen. It doesn't look like it, but history does tell us these things do happen. So when you're investing, don't have all your eggs in one basket on one day, but be prepared that what you do have might go through a sustained period, a down period. And I don't predict this, but if it does, you've got to have the stamina to withhold it, to bear that temporary loss, and don't get suckered into saying, "Oh my God, it's all over. I'm out of here." That's what I would say.
The steepening of the yield curve is not just a technical adjustment, it's a reflection of deeper structural stresses in the debt markets. Governments, particularly the US, are leaning heavily on the short end of the curve, issuing vast amounts of short-term paper to keep borrowing costs down in the immediate term. While this appears affordable, it accelerates rollover risk, compressing timelines and leaving little breathing room when maturities stack up quickly. That cycle speeds up the pressure on funding and creates a fragile system vulnerable to sudden shocks. When the market no longer absorbs this debt smoothly, central banks step in under the banner of yield curve control. This process transforms their balance sheets, shrinking during tightening phases, then ballooning again as they monetize government liabilities. Each round of intervention fuels monetary expansion, pushing fiat credibility closer to breaking point. History shows this pattern doesn't end gradually, but with a sudden reset, where holders of debt and fiat instruments suffer the most significant losses. Let's get back to the interview.
What do you think about the steepening? Is that a sign that it's going to be really hard for the central banks to cut? And do you think the Fed will just ignore that and keep cutting?
Me?
Yeah.
I think Clive's summation was very accurate.
Okay.
The tendency to deal with short-term funding requirements and cut rates is going to further exemplify the steepening of the curve. And in fact, beyond just steepening, I've been talking about the fact that a lot of people, for affordability reasons, and America's right in the mix with this, they've been shortening the duration that they're putting their debt out to such a degree. And I keep just showing, I try to give visual mind and metaphors for people to help understand this. And it's like the big cog on my motorbike that I was riding today, and then the small cog. And essentially, if you put something out for 30 years, actually you need a full revolution of 30 years on the rear wheel before that debt comes back and you actually have to pay it back or roll it again. Yes, you have some interest rates to serve, but at least you've kicked that problem quite long down the road. What's actually happening in terms of reset is all the dynamite sticks as fuses are being shortened. Because when you move from the big curve and you put it on the tiny sprocket, so here's the news. Let's talk America because it's so important. Trump, yay, tariffs are winning. We got 30 billion in. No, you used to get 7 billion, so you got a net new 23 billion. That's for the last 30 days. What else happened in the last 30 days? Record borrowing, 550 billion. Oh, wow. What is 23 billion or 550 billion? 4%,
Nothing.
in call it new income, if you will, on that excessive new borrowing number. Now, interestingly enough, on that 550 billion, 100 billion of that went out on a 4-week debt. I saw that same tweet you're bringing up. Yeah, that's excellent. 100 billion went out on a 4-week. So think of my little bicycle cog. Instead of having like 6 or 7 teeth and you've got the big old 33 at the back, you're actually going down to about a 3-teeth cog. And that thing is spinning like mad hell. Before the month's fully up, if you're in a 31-day month, that money is coming back at you and one's putting out again. So if you think you clog a fat pipe on the end of the debt time continuum, when you get to the much thinner pipe, you clog that up double fast. But everyone goes, oh, well, the central banks control the short end. No, they don't. Not when you pour that amount of volume of crap through that pipe. You're going to get a block pipe, and that's the end of it all. So this whole notion that they found some new place to hide and it's innovative thinking, no, they're forced to get a cheaper interest rate, which is more affordable so that they can extend and pretend a few more days, weeks longer. But the cycle of time that they are buying is getting ever slower. And with that level of borrowing I just described, all being dumped on the short end, Clive is right that they can, for now, manage that down and you'll have a steepening of the curve. But then eventually both parts, and we're talking about the full collapse of debt markets as an asset will occur. And that's putting the stick through the wheel of the bike and all fall down. That's how I see it ending. You don't get long pieces of rope when you start chasing the short end. I'd be interested in Clive's take on that because he's got a good eye on the debt markets.
Well, borrowing at the short end to the exclusion of the long end is, for a government, a dangerous policy because you're putting far too much focus on the rollover problem of ever increasing amounts rolling over in the short run. So that's a dangerous strategy. But at some point, that does go wrong. And when it goes wrong, we get what's called yield curve control because the central bank is invited, encouraged, or told to intervene and buy the bonds at the slightly longer end or longer end that the government cannot sell to anybody else. So this is when in the United States, that we've seen in other countries, where the central bank steps in and buys from the government the money that the government has to borrow at the longer end. And what that means is the central bank prints the money which is required to buy those assets. So the asset side of the balance sheet are the bonds it buys, but to get the money for those bonds, it has a liability. The liability is the electronic printing of the money which is used to buy those bonds. So what that means is we go from what has been happening, which is called quantitative tightening, which is the shrinking of the central bank's balance sheet, to what's called quantitative easing, which is the expansion of the balance sheet because they print money, more liabilities, and they buy more assets, the bonds, which is exactly what happened in 2008 in the global financial crisis, and it's exactly what happened in 2021 when we had the pandemic. And it's what's exactly going to happen, I think, probably sometime next year when we go into a sovereign crisis. The government can't fund itself anymore at reasonable rates, and it's forced into this situation of saying to the central bank, do as you're told. And this, of course, is what we're starting to see with the US government, specifically Donald Trump, starting to take over influence over the central bank by putting in place people who will do his wishes or toe his line.
Doesn't that make the Fed the toxic bank because it becomes the buyer of last resort of assets that are hyper overvalued that should be allowed to price discovery lower?
Well, when I did Economics 101, and we're talking about 50 odd years ago, well, actually it's more than that, but they used to call the central bank as the lender of last resort. And that meant lender to the banks or lender to the government. Now, I haven't heard that word being used except by me recently, but that's effectively what central banks are. They're lender of last resort to the government when it runs out of money.
But I'm saying if the bank becomes, the central bank becomes such a toxic bank, and you're not getting the fact that rates should in fact be a lot higher, as Peter Schiff is pointing out, and the debt far more devalued with a better return for a higher inflation rate, all this good stuff. When everyone looks at the country, they should be looking at every central bank as a black hole. It's such a toxic bank, and that they are actually playing a role of supporting a hypervalued debt market that should actually be correcting. At what point does the contagion happen? Because they are the asset owners of borrowing that a government is doing that is generally non-productive. We've all passed, all the big nations are well through the Reinhardt Rogoff 90%. Well, not all of them, not maybe Germany, etc., but there or thereabouts. What forces the fact that you can't ugly up a central bank to such an extent? That when does the market just not accept anymore the monetization of the debt? It's surely not infinite, is my whole point. How does that triggering? I'm curious what Clive and you think, Mario, in terms of that.
I'd like Clive.
Francis,
go ahead.
Francis, I think we're both on the same page that what then follows down the line, and we can't put a timescale on this, but we know it comes suddenly, is the monetary reset. And whether that takes the form of a jubilee, where basically the debt is in some way, shape or form just forgiven. When I say forgiven, it means that you lose your money if you've got any of this. Or whether it means they bring in another currency which has to be used instead of the old one, so they don't technically default, or whether it means some other system. But we basically get to this reset situation where the losers are the holders of not only government debt, but of debt of monetary assets, financial assets denominated in fiat, repayable in fiat of every kind. And I think that's something which comes. We just don't. I think it comes in. We have two waves. The first wave is the central bank stepping in as lender of the last resort, buying all these government bonds, expanding the money supply. Then the money supply is expanded to such an extent that everything is going crazy, and people are saying, "Well, I've got all this money. I've got to rush down to the shops and buy it while it's still there. Buy the whiskey, buy the exercise machine, buy anything I can lay my hands on because I've got to get something to preserve my wealth." And then the situation gets to the point where the government steps in and there's a crisis, so they say, okay, reset time. Everyone's only allowed 10,000 of the new currency, and you can't change any more. Whatever this, but we know that there's going to be the losers will be the holders of fiat at the end of the day. It doesn't matter which way it comes.
Yeah.
I agree 100% with what Clive said. And I mean, this is what I think gold is telling us, that they're going to go crazy, the central bankers, because they've got no choice but to print to keep the debt going. But what that is going to do is going to sink every currency to oblivion. And eventually you won't be able, like Clive said, I'm going to go to the shop to buy whiskey, but people are going to go to the bullion dealers as well to buy physical, because the currency is going to become, well, at some point, and that's the collapse, really. At some point, you won't be able to exchange your dollar, your paper dollar or pound or euro for gold.
The financial system is being pushed toward limits that cannot be managed indefinitely. Short-term fixes, whether through compressed maturities or central bank balance sheet expansion, are not solutions but accelerants. The more liquidity is created to sustain unsustainable debt, the faster confidence erodes in the very currencies underpinning the system. That erosion ultimately drives capital to seek safety outside of fiat structures, and history shows that those who prepare ahead of time are better positioned when resets arrive suddenly. This is not about speculation on daily moves, but about recognizing long-term cycles of debt, money, and trust. Protecting wealth in such an environment requires foresight, patience, and discipline as the ground under global finance continues to shift. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.